You're losing thousands of dollars trading. As a beginner, I did too. And you're probably repeating the exact same mistakes right now. But I'm here to help you stop losing money, and that's if you avoid these 5 trading mistakes, starting with the first. When I was in school, some of my friends put money together for me to trade with. Some of them even gave me their school fees. The moment I collected that money, I was finished, even before I placed the first trade, because mentally I was defeated. Imagine looking at your trading account, and when you're about to press the buy or sell button, your hands are shaking. That's because you remember that if you lose this trade, someone might as well just drop out of school. That's not trading, that's gambling with emotions stacked against you. And that's what so many of us keep doing. We trade with rent money, food money, and school fees, thinking trading will solve today's problems. If you can't afford to lose it, don't put it in the market. You're better off just spending that money on a stick of cigarette. You know that feeling when you see a setup? It's clear, it's textbook, but your fingers wouldn't just press that buy or sell button. And that's the second mistake that keeps so many traders broke: the fear of pulling the trigger. During the weekends, I would spend about half an hour over analyzing the charts. Then I'll look at some setups and say, I'm not sure this looks perfect, but only to show up to the charts on Monday and see that the markets have left without me. And the funny part is, the trades I avoided were usually the winners. The ones I overhyped and thought that was the perfect setup, those are the ones that actually just smacked me in the face. Trading is a numbers game. You basically need to take a bunch of trades and create a sample size. But because I didn't trust myself, I was sabotaging my own results. If you're scared to pull the trigger, you're not trading. You're just basically window shopping the markets. And window shoppers actually don't get paid in trading. It is the ones that are disciplined and have the guts to pull the trigger when that setup presents itself. So how do you fix it? You start small. Not demo account small, but real money small. Fund an account with enough money to make you respect a trade, but not enough to make you have sleepless nights when you lose a bad money. For me, the sweet spot is usually around $300 to $500. But anyways, small accounts usually vary. To someone, $10,000 is a small account, while to someone, $100 is basically a small account. But I don't think it makes sense trading with a $100 account. Now, if you risk $3 to $5 per trade, two things actually happen. First, you actually care enough to treat it seriously. Secondly, you build confidence without the pressure of blowing a $10,000 funded account. Most people blow funded accounts not because they don't know how to trade, but because they're trying to be so careful not to fuck things up, and then they end up fucking things even more. Fear is what actually makes you freeze. But if you have confidence in your trading setup and it shows itself, then you pull the damn trigger. Now let's talk about the graveyard of all traders. I used to think like this: a trade is not a loss until I close it. And even worse, I had this dangerous belief that what goes up must come down, and what comes down must go up. The truth is, gravity is not applicable to the markets. One of the fastest ways to ruin yourself as a trader is to ignore using stop losses. You keep holding onto a losing position, hoping that it's basically going to retrace. And before you know it, your $1,000 becomes $500, and your $500 becomes $200. And then you are still hoping, holding, and hoping the trade is going to retrace. And by the time you accept the truth, the loss becomes so big that it's difficult for you to accept it. But one thing that I guarantee is that if you can't take a small loss, then you're definitely going to take the mother of all losses. Not using stop losses is basically you saying, I'd rather the market decide my future than me actually taking control. And here's the trap: sometimes it's not even about greed. It's about psychology. Imagine you've got Bitcoin and everyone is expecting it to rise long term, right? So you go long. Now, instead of trading the markets in front of you, you start looking for every signal that justifies your bias, and you ignore the sell setups. You convince yourself that the dip is only temporary. But the truth is, the markets don't really care about what you want. What's going down can actually keep going down. The dip can keep deepening and deepening deep enough into your trading account. That's why stop losses aren't just about math. They're about protecting you from your own brain. The markets will retrace, Sure, but sometimes it retraces after wiping your entire account. Taking a loss sometimes makes you see the markets even clearer because you have no attachment whatsoever. Whether it's going up or down, you're seeing the market through the lens of what it truly is. We've all been to the supermarkets, right? Even during Black Friday and holiday sales. And then you see these placards everywhere carrying signs was selling for 10,000, now selling for 3,000. And all that is basically to encourage you to buy some more, because when something is selling at a discounted price, it's supposed to encourage you to purchase even more of that product. But that's exactly how so many traders think. When you're in a losing position and then you're adding to your losses, it's called the supermarket mentality. One time back in 2020, when I was trading gold, I was in a buy position. Mind you, it was in a huge loss, like 70% of the account was red. And then I marked what I considered to be some key levels where I thought the price will definitely find some support. And then I told my friend, if price gets to this untested support level, I'm going to buy some more. And he was like, yeah, it's definitely going to react to that level. To me, I was getting a good bargain, but that mentality in trading will definitely keep you broke. When price drops from $1,000 to $500 and you're like, wow, I'm getting it at half the price. Then it drops to $100 and you're still adding, saying I'm buying the dip. My brother, what makes you think that thing is not going to get to $10? The markets basically do not reward hope, they reward discipline. Right now on social media, everyone is sharing screenshots of their 1:100 trade, flipping $50 to $5,000 in just 2 days. And you're thinking to yourself, oh, risk management does not apply to me. I beg you in God's name, if you care about your sanity and your growth as a trader, stop going to Twitter. So many people there make you believe that trading is so easy. I can almost swear on my life, a lot of those guys can't show you a track record for 6 months straight. I've been there before, risking 10 to 20% of my whole account on a single trade because I thought the trade was right, because I was told to believe in myself. But belief is not a risk management tool. You can believe with all your heart and the markets will just slap you in the face. Professional traders don't flip accounts every single week, even though that's what it doesn't seem like these days, because everyone is getting 100 to 200% of their account in a week. They survive, they stay consistent, and that's how you build wealth from this trading game. I made all these mistakes that you're currently making, but I was able to fix them one mistake at a time. If you want free weekly insights and updates on key levels with entries and invalidations, then click the link in the description. Otherwise, I think YouTube wants you to watch this video.